Welcome back to Milkshakes Markets and Madness. This is a show where we talk about the financial markets, the madness surrounding those markets, and we do it all through the lens of the dollar milkshake theory. And obviously, as we've detailed as we've gone over in detail over the last month, we've had plenty of madness to talk about. But while the craziness really happened, in some of March and really the first week of April, markets have started to climb their way out of it. And so what we're going to talk about today is some portfolio hedges. Are they needed? Should they not be used? And if they are used, when should they be put on and when should they be taken off? And so what I thought I would do today is just look at a couple charts to begin. And we'll do that by this is a chart that just shows just a number of various risk assets around the world, from gold to oil to the NASDAQ to the Nikkei to the DAX. And as you can see, back in the first week of April, we had pretty significant sell-off post Liberation Day. But then just about everything has been slowly pulling its way out. Gold obviously did extremely well. It's pulled back a little bit, but everything else is kind of slowly climbing out of this. And so the question becomes, what do we do now? Where are we at? What comes next? And while I don't have any specific answers, and while I don't have a crystal ball that tells me exactly what's going to happen, I think I have an idea or at least I have a roadmap that I'm going to be following. And I thought what I would do today is just kind of walk you through what that is. So if we switch over here, we're going to look at a few charts year to date, and then we'll get into a little bit more detail. Essentially, what I want to do here is just look at this is the VIX going back to the beginning of the year. And you can see it bounced along, between 15 and 20, got a little bit up there in February, pulled back a little bit in March, and then had the big spike into the first week of April, and has subsequently pulled back down. The S&P 500, which often acts opposite, saw something similar in the first couple months of the year. It went up a little bit, and then it had from year to date, it had about a 15% pullback. From the peak to the trough, it was more like 18%, and then it subsequently had a 10% bounce. Now, if we overlay those against each other, again, we can see that they don't always go perfectly opposite of each other, but they often do. And this actually helps explain how the VIX is calculated. The VIX is calculated by looking at a number of options, both out of the money, both put options and call options, that range, I think, from 3 to 5 weeks of maturity and various levels of out of the money. And so what the VIX is really telling you is not what has happened. It's telling you what the market is expecting to happen. And again, it's calculated based on what the market is expecting to happen with the S&P 500. So oftentimes, especially for retail investors who perhaps don't have all the same instruments to trade at their fingertips, and perhaps not the expertise to trade at their fingertips, it is often cheaper and easier to buy and trade portfolio hedges by just trading options on the S&P 500 or the SPY ETF than it is the VIX. I will often get questions saying, hey, should we buy calls on the VIX? How high do you think it could go? The problem with trying to buy calls on the VIX is you bring some additional complications into it. Number one, now you're trading options based on futures rather than just an equity index. Options on futures have a whole set of characteristics and variables that perhaps you're not used to. And again, because most of the time, or because the VIX is calculated using the S&P anyway, if you're betting on the S&P, you're getting a direct exposure to it, whereas the VIX is kind of a derivative of the S&P 500. So what we're going to look at today is we're going to look at some different hedges on the SPY rather than on the VIX itself. But let's zoom out for a minute and let's go back to 2022. And the reason we're going back to 2022 is many of you have heard me say for many months now that 2022 was kind of my analog for 2025. And the reason is because in 2022, we saw significant volatility, but we were also, and when I say we, the world was dealing with a whole regime change. That regime change was an environment of aggressive interest rate hikes by the Federal Reserve. And, that just hadn't happened for a very, very long time. People have had long careers on Wall Street without seeing an aggressive interest rate hiking cycle. And the world kind of had to come to grips with that. And it took about 9 months for the world to come to grips with that. There was a lot of uncertainty of how far Powell was going to go, how fast he was going to go, what the terminal rate was going to be. And markets just don't like uncertainty. And so what I did here is this is 2022 in the S&P 500, but I highlighted the first 9 months because the first 9 months is where we saw the downside. And over that 9 months, the S&P 500 pulled back 25%. But as we've also discussed prior, we saw several rallies along the way. The first drawdown was around 12, 14%, I think, and then it had a 6% rally. And then we had another drawdown and we saw a 10% rally, then another drawdown, we had a 7% rally, and another hard drawdown and a 17% rally. And then the hard sell-off late summer into early fall, until we finally found a bottom. But the point is that markets don't move in a straight line. Even when they're volatile and even when overall directionally there is a trend, there are going to oftentimes, not always, but there are oftentimes going to be counter trend rallies along the way. And that's what I think that we're going to have this year. I've said this many times, and so far it's playing out rather similarly. We had about a 15, 16, 17% drawdown in the S&P 500 in the first 3 months. Now, since then, we've had about a 10% rally. And so, we've got to decide, where are we going from here? Are we going to rally more? Are we going to go sideways, or are we going to pull back? But I think this is a good gauge to use, because I don't think the full downside has been experienced yet. I think there is more volatility to come. How far? I don't know. I am actually kind of cautiously optimistic for the second half, or at least the fourth quarter of this year. I think by the time we get into the late third quarter, fourth quarter, perhaps we're going to have better visibility on where we're headed. We're going to have better visibility on what's going on with China and the United States, and whether or not they're decoupling. We'll hopefully have more clarity on what Trump's plans for the tariffs are. And we'll hopefully have more clarity on what's going on in Europe with Ukraine and Russia. But the point is I do think there's going to be more downside. I expect there to be a lot more volatility, but I expect there to be several counter trend rallies along the way. But I want to focus here. I'm going to use this tweet that I sent out on April 8th and as kind of the basis for this discussion. And what I said at that time is that was kind of the height of the sell-off, the height of the madness, height of the volatility. And people were finally waking up to the fact that Trump was serious about tariffs and that he wasn't necessarily going to pivot at the first sign of volatility. And I said, investors are just now realizing that Trump was serious, and as such, buying puts for the first time with the VIX at 50. And I used the meme from Gladiator where the guy stands in front of the emperor and says, "We who are about to die salute you." And the reason I put that on there is that is not the day to be buying hedges. The flood has already come. It has already been raining. If you weren't like Noah and hadn't already built your boat, you were too late. And if you've done this long enough, you can just see this coming. And then that was, people were apoplectic on that date. And, we had a couple things that kind of alerted me to this. Number one, that was the market had sold off very hard. I mean, at that point, it was 18% from the peak and about 14, 15% from year to date. Again, markets just don't move in straight lines, and you could just feel the kind of the peak fear in the market. And sure enough, that was the day that the VIX, spiked above 50. And, it was headed, everybody thought it was headed higher. I was interacting with somebody on Twitter who said it was going to 100 or 150 in the next 2 or 3 days. And listen, this is the thing, is I'm not saying it couldn't have gone that high, but it just typically doesn't. Once you get VIX to that level, you are oftentimes going to start to at least hear rumblings and see some headlines of potential action by central banks, because they can't let it go too long. Because if they let it go too long, then it gets to a point where they can no longer control it and can no longer help. And so I could kind of just feel, with all the fear in the market and with the way things were going, that we were probably getting close to at least some walk back on the tariffs, and potentially even some comments from central banks around the world. And the other thing I'd say is this wasn't just happening in the United States. Markets around the world were selling off pretty significantly. And this kind of talks a little bit more about what I mean here. So this is the VIX going back about 20 years. And you can see there's several spikes along the way, but the spikes just don't last very long. And what you don't see the VIX going to 100 and then sitting at a plateau of 100 or 70 or even 50. You'll see these spikes, and then it typically comes back down pretty quickly. And the reason it comes back down pretty quickly is because it has to. Because if it doesn't, then the whole system's coming down. And so if you're trading the financial markets and you're not praying for the whole system to come down, when you see these spikes, those are the spikes. If you have been prescient and been prudent and have already bought your insurance ahead of time, those spikes are the time where you want to start taking it off. Those spikes are not the time that you want to start putting them on. But let's take a little bit closer look. So here we go. But now this is now I have the SPY ETF. It's not the S&P 500. It's the SPY ETF overlaid with the VIX. And I'm pointing to the points where the VIX is down here below 20, and even in some cases at 15 or lower. And you've got markets at their all-time high. That is the time to buy insurance, even if you don't think you need it. When insurance is that cheap, it's just prudent to buy it. And if it expires worthless, you know what? That's just the cost of doing business while having some of your backside protected. I say this all the time. I am more than happy to burn a little bit of premium in insurance in order so that I can sleep at night and so that I can keep my wits when everybody else is freaking out. And if the market goes up 15% that year and I spent 1 or 2% on insurance, and as such, I'm up 13 or 14 rather than 15, that's fine. Because when it does pay off, you more than make up for that portfolio drag when it doesn't pay off. But, this is the time to buy insurance when the VIX is really low and it doesn't cost very much. So if we go back here at the beginning of January, and it was kind of like this in December as well. And then in early January, I use January 23rd here as an example. The S&P was at 610. And a June 30th 600 strike put cost $16. So that would have been a little bit over, about 1% out of the money, maybe a little bit more than 1% out of the money. And you had almost 6 months of protection. And the VIX was around 15 at that point. You're just 15 on the VIX. That's pretty low. You're not typically going to get very much lower on the VIX. Of course, anything's possible, and I'm not saying it won't go there again, but for me, anytime the VIX is below 20, to me, that's starting to get pretty low. And if it gets into 15 or lower, to me, that starts to get extreme. So at that point, a June 30th 600 strike put would have cost about $16. So let's look at that. So on January 23rd, 610 on the SPY. A June 30th put would have cost $16. So 16 divided by 610, that's about a 2.5% premium, it would cost about 2.5% to protect a portfolio exposed to the S&P 500 until June 30th. So, that's, to me, 2.5% to protect your portfolio for 6 months, pretty close to at the level it was at. Listen, it just doesn't really get that much cheaper. Now, it's gotten cheaper than that a few times, but that is pretty cheap insurance. Okay, so let's just go forward now. So this is what happened over the subsequent, couple months. It actually got a little bit cheaper, and I think it cost $16 in late January. At one point, it got as low as $13 in the middle of February. But then when it paid off, it went from 16 where we bought it to 108. So that's a return of almost 7x. So in that's a case of the insurance paying off and paying off relatively quickly. So let's look at this from a portfolio performance perspective. Let's just see what this would mean. Okay, so if you started the year with a portfolio of $100,000 and you decided that you want, because of everything going on with Trump and because of what's the craziness of the world and the VIX was really low, that you did want to buy some insurance through June 30th, and you're going to do this on your portfolio of $100,000. So that means the puts would have cost you $2,500. These are approximate numbers, and so let's just keep that in mind. So your portfolio allocation would have been, if you were all in on the S&P 500, you would have had $97,500 exposed to the S&P, and you would have had $2,500. Sorry, this formatting got a little messed up when I uploaded it. You would have $2,500 in puts that expired June 30th that were about 1% out of the money. So then we fast forward to April 8th. Okay, so the S&P has gone, or the SPY has gone from 610 to 497. It's about an 18% drop there. So the SPY position is now not $97,500. It is now $80,000. So you've lost about $17,000 there. But the S&P put position has appreciated from 2,500 to 17,500. So overall, your portfolio size is now 97,500. Now, did it 100% perfectly protect your portfolio? No, but pretty darn close, right? And while everybody else that was all in on the S&P 500 is sitting at 80,000, your portfolio is at 97,500. Not only that, but now you can bank that S&P put, and you have these profits that you can then potentially play with going forward if you want to put some more protection on in the future. But let's take a look again, because again, I said, the going back to the meme, those who are about to die, we salute you. Because the point is if you did not already have those hedges on and you're trying to put them on post Liberation Day, when everybody else is trying to do the same thing and everybody else is freaking out, the cost to buy insurance here is much higher than it was back in January. So let's take a look and see what that would have been. Okay, well, at that point, a June 30th, 492 strike put, so that would have been about 1% out of the money as well. Those were costing about $30. So remember, back in January, we only had to pay $16 for 6 months, or almost 6 months. Now, for a little more than 2 months, you got to pay $30. So that means that's about a 6% premium. So from April 8th to June 30th, $30 over 497, that's a 6% premium. So, you're paying almost 3 times as much for a put, and you've got about a third of the amount of time left, or half of the amount of time that you had a couple months ago. That's how much more expensive it was to protect a portfolio on April 8th than it was at the end of January. Now, you might be sitting here saying 6%, that's not so bad. Well, if the market would have continued down, sure. But 6% for 2 months, that means to protect a whole year, it would be 36%. Come on. That's very, very expensive. So again, this just goes back to buy insurance when you can, not when you want to, because trying to buy it in the midst of the chaos, it's just going to be prohibitively expensive. And you are probably going to be one of the gladiators lying dead in the arena in honor of the emperor. It's just the way it is. But let's look a little different. Let's say you didn't want to go all the way out to June 30th. I don't need that much protection. I just want to get through the craziness. Well, the fact is if you just went out 2.5 weeks, if you just went to April 25th, so not even 3 weeks, just 2.5 weeks from that time period, those puts cost $20. Okay, so $20, that's $20 over 497. That's still a 4% premium You got to spend 4% of your portfolio to protect it for 2.5 weeks. So again, as soon as the VIX start to rise, insurance prices rise dramatically. And that doesn't have to rise that far to start to become more expensive than it's worth. And so when you get the VIX spiking and you come in and your portfolio is totally exposed and you wake up and the VIX is above 40 or above 50, I mean, the damage is really already done. It's really, really hard to put insurance on at those levels. Now, I'm not saying it will never pay off. It may very well pay off. But the asymmetry of the puts at that point is kind of gone. So again, on April 8th, it would have cost about 4% to buy a put, 1% out of the money to protect the portfolio for less than 3 weeks. So again, you're buying a put that's 1% out of the money and you're spending $4 or 4% to do it. That means the market has to fall more than another 5% for you just to even break even on the put. And so that's why you got to be very careful about your entry points and your exit points. And it's also why when the VIX does spike like that, even if you think the worst is not behind you, you need to start taking some of that put protection off. At a minimum, sell some of it or start rolling those puts down and lock some of that profit in. Because typically, like I showed at the beginning, the VIX doesn't stay at this new permanently high plateau. You typically get a retracement pretty quickly. So let's just look at this again. So when markets are high and VIX is very low, that's the time to buy insurance. When the VIX is high and the market's low, that is not the time to buy insurance. So where are we now? Well, the markets have bounced 10%. The VIX has come down dramatically. At the close on Friday, it was just below 25. And so I would say at this point, if you don't have any protection, either sell some of your positions now that we've gotten the bounce, or perhaps start nibbling on some puts. They're not cheap at this point, but they're cheaper, much cheaper than they were. They're not as inexpensive as they were back in January, but they're not as expensive as they were a couple weeks ago. And if we use our 2022 analog, we're probably at the point in this bounce where we're probably either going to go sideways or turn around and fall going forward. And there's still a number of headlines ahead of us. There's still a number of factors going on with all the variables we talked about at the very beginning that could very easily send this market down back to the lows that we experienced at the end of April. Let me see. I don't think that I think that's the last slide I have, but what I would expect is if we get back to, I'll tell you what I'm going to do. I'm not telling you what you should do, but we sold most of our puts 3 weeks ago into the spike. We kept some, we kept some that we rolled down in case it goes lower because we do expect it to go lower. And we have just slowly started adding them back as the VIX has started to come down. If we get the VIX back below 20 or even in the range of 20, we will very likely start adding more protection to the downside back because we do think 2022 remains a pretty good analog. So anyway, I'm going to leave it at that for this week. Hope that makes sense. Hope this has been valuable. Again, buy insurance when you can, not when you have to, because if you buy it when you have to, the guy selling it to you is probably going to be the one that makes the money. All right. Have a great week, guys. We'll talk to you again next week.